Two, one. You're on, Bob. You're on, Bob.
Oh, I'm on. Okay. Well, welcome everybody. Another great session with Roger Royce. I think we're maybe on our ninth session this year, learning all kinds of aspects of the law that apply to startup companies. I'm learning a lot, having a lot of fun. And so, Roger, let's get it going. I think we're doing tax today and all kinds of good stuff.
No, no, we're not. We're doing finance and accounting.
Well, that's close. Isn't that close to tax, Roger? Come on.
Well, you're going to find out that it's close, but not the
Thank you.
same.
Okay.
But it was a nice try, I guess. Okay, I'm going to hit share. I'm going to hit slide presentation. You should see my screen in slide mode, presentation mode.
Roger, you got it on the first try.
Oh, awesome. I'm getting so good at this. That just
2026.
my day. You can go home now. I'm done.
Yeah, there you go.
Congratulations,
Okay.
Roger.
So this is finance and accounting. You might wonder why a lawyer is talking to you about finance and accounting. It turns out that I am also a CPA in North Dakota and California. I just got licensed in California about 5 years ago after taking my CPA exam in 1981. Talk about putting things off, huh? And I'm licensed for what they call non-attest. And I have to say that if I say I'm a CPA. I've never practiced as a CPA. And I've certainly am. So non-attest means I don't do audits or reviews. I don't even do compilations. I really don't do numbers. I can do tax. I could do, some things that are not a test, and I'll tell you what a test means in a little bit. But I don't. I do law. I leave the numbers to the professionals, to the accountants. However, we really have to understand when we do startup law a little bit about numbers. So now, when I first moved here to California many years ago, 91, I think, I got involved in a deal out here. It was an acquisition. And I remember this because, and I was doing tax and corporate at the time. And my big boss that I was working for, every day we would sit down with the accountants and he'd say, okay, here's the assumptions. This is how this contingent consideration is going to work. It's going to be based on this number or this metric and that metric and this. So run these numbers and bring them back. And then they come back with a set of numbers, and we would just spend so much time on the numbers. And I just remember him saying, you got to pay attention to the numbers. You just got to pay attention to the numbers. So today, I'm hoping that we can have a good hour on what those numbers mean, how they're presented, why they're important, where they come up in legal practice, and maybe just how this can help you. Now, I know, as we always say, this is not legal advice. It is information. I'm a lawyer, not your lawyer, at least not right at this moment. Maybe before this and maybe after this. But if you got specific questions, you change the facts, you change the results. So you really have to rely on lawyers. And in this case, a lot of what I'm going to talk about, you probably want to rely on accountants as well, because a lot of this is going to be accounting. Now I'm going to go, this is a summary, I guess, of a handful of things I'm going to talk about. Some of this for many of you is going to be just so super basic, but I am not going to make any assumptions about knowledge because I've worked with too many startups that do their numbers on QuickBooks or Quicken or Excel because it's just so easy. And then they get into trouble when they make representations to investors. And I've been through this many times where that's the first time everybody kind of realizes that, oh, they really don't understand accounting. So I don't make any assumptions anymore. That's one thing lawyers should never do is make assumptions. So let me just start off with kind of, a crowning principle. The thing that you're going to hear about a lot is GAAP, generally accepted accounting principles. And what's interesting about this is that people think that let's say that non-accountants talk about GAAP as though it exists out there in the ether somewhere. and can be divined through logic. When, in fact, just like other legal principles, it is a standardized set of principles that's based on some established bodies that basically say these are the standards. And GAAP, I find, is a range. There's different GAPs. GAAP can authorize different ways of looking at things. I'm going to talk a little bit more about that and how you can get in trouble if you think that it is anything other than that. So we have to have a little bit of an understanding of GAAP, because it's going to come up over and over again. When you get a financing, you're going to make representations as to your financial statements in accordance with GAAP, or that you're going to get results in accordance with GAAP, or that something's going to be GAAP. So we're going to talk a lot about that. So just keep that one in mind. Generally accepted accounting principles established by FASB. And if you're publicly traded, you got the SEC enforcing it. But we're going to talk about startup companies today. So as a lawyer, the first thing I do when I think about pretty much any concept, I say, well, where are the rules? How do I find out what the rule book is and what to find out? Well, we talked about GAAP being issued by FASB, but there's also an international financial reporting standard that are used in a lot of other countries. If you're a public company, you're dealing with the Securities and Exchange Commission. And also, if you're auditors of public companies, they have to deal with the PCAOB. So for our purposes, mostly it's a FASB. And there's some other agencies I'm going to talk about in a little bit. Now, there are some other applications that we can find where accounting becomes important. So again, this is very startup focused. So number one, and probably the biggest one for everybody, is the Internal Revenue Service. It requires accounting records to be maintained in place. Even though tax accounting is much different than financial accounting sometimes, the IRS does require companies to keep these records. You can't just walk around with it in your head. That sometimes surprises people to think that there is a law that imposes an affirmative obligation to write things down, but there is, and that's the tax law. Courts will sometimes order accountings in disputes, and we also have these professional codes. Also, regulatory agencies, depending on your business, might require certain types of records to be kept. We talked a little bit about sources of authority, so let me not dwell on that. Now, we talked about GAAP, and it's pretty rare that I run into a startup company that is compliant with GAAP, at least from the get-go. Usually people start off with something a little simpler. They don't want to hire an accountant to make sure they've looked at the rules issued by FASB and are doing everything in accordance with GAAP. So they'll do cash basis, which is just exactly what it sounds like. Your revenues are cash in, your expenses are cash out. Or maybe they don't pay much attention to financials because nobody's asking them for it. So they just worry about tax accounting, which I'm going to talk about in a minute, which is oftentimes different. But I also am going to talk about some other things, managerial accounting, and maybe some other systems. Cash, we talked about. Modified accrual is a system that we see. It's different than cash because it'll recognize revenue. In other words, they'll go on your income statement possibly before you actually receive a cash receipt when the amount's measurable and available. That's not a GAAP standard, by the way. And they'll pick up expenditures as expenses that will go on your income statement when a related liability is incurred. So we'll see modified accrual. Now, in private companies, it's not GAAP. That is something that is used and is a standard in governmental entities or governmental accounting, but we're not talking about that today. And then tax accounting. I said it was different, so let me just tell you that where it's different. Again, that is not GAAP. Tax accounting is its own creature, and it's a creature of statute. And it is much more concerned with ensuring compliance with the tax laws and honestly implementing policy consideration. So, for example, well, let me just say there's two differences. One is what we call timing difference, and the other is what we call permanent differences. So let's use an example. The accounting concept might say that we recognize a certain expenditure as an expense for accounting, like maybe a meal that you buy, a business meal. But the tax concept might say you don't get a deduction for that, so we don't recognize that. Well, that's a permanent difference. Your accounting expense and your tax deduction are going to be two different things in that case. That'll never reverse. A timing difference is where maybe the accounting standard says we depreciate this property over 10 years, but the tax law might say, you know what, we're going to let you depreciate it over 3 faster. Well, you're going to get a difference every year in accounting depreciation and tax depreciation, but eventually it's going to be 100% cost of the equipment. So that's just timing. And the reason I'm pausing on this is for 2 reasons. Number one, to kind of highlight the fact that what you're doing on your tax return isn't good enough for financial reporting. It's different. And secondly, that there is a whole body of accounting that deals with these differences. And it can be, it's a seminar in its own right. It can be very complex just in accounting for taxes. And I haven't even gotten to the accounting for taxes yet, because that also is something that has to be kept track of on your financials, but just accounting for these differences. A couple definitions before we get into financial statements. Cash flow, just cash receipts and expenditures. When I say gross profit, I mean revenue minus cost of goods sold. These are all terms of art. And cost of goods sold, if you're a services company, that might be your cost of services. Product company, it's exactly what it sounds like. It's how much inventory you basically use up during the year. Operating profit, sometimes you hear EBIT, earnings before interest and taxes, sometimes EBITDA, interest before earnings, before interest, taxes, depreciation, amortization. But when I say operating profit, I mean gross profit minus your operating expenses. And then net profit or net loss is your operating profit minus non-operating items like interest, taxes, other non-operating costs. Accounting elections. So it's worthwhile, keep in mind, remember what I said, that accounting is somewhat of a range sometimes. So there are some elections here. And revenue recognition, there are different ways to account for different types of revenue. For example, there is something that we see in tax accounting a lot, the installment method, where you pick it up as revenue when the payment comes in. Sometimes in tax accounting, you're allowed to use completed contract. You pick up the revenue when the contract's complete. Similarly, with depreciation, there are elections. We have to figure out a useful life. Let's call it conventions rather than elections. Elections probably a little misleading. There's a useful life convention. What is the life of this piece of equipment that you're depreciating? What's the reserve? How much is it going to be worth at the end of its life that you're able to sell it for? And then what's the method? So usually, like straight line is just the same amount every year. There's declining balance methods, double declining balance, etc. And then inventory. So there are different methods of inventory accounting. FIFO is first in, first out. And the assumption is that the first product that goes into your inventory is the first one that you sell, because you're matching the cost of that product with the revenue from that product. Another convention is LIFO, last in, first out. You're matching. So if you're buying products at different prices, same product, different prices, you're specifically matching them. By the way, that's another method, is that specific identification. But LIFO or FIFO are generally two that people use most. I'm just going to pause on software for a minute, because this is startups, and I usually do tech startups. I mean, there's this whole body of accounting literature around software revenue recognition and expenses. I've cited a couple of them, and we'll talk more about the ASCs and ASUs, but those are interpretive guidance on how to deal with software. And I don't want to dive too deeply into this, Suffice it to say, there are rules around this about what costs in developing software have to be expensed. By the way, unlike tax, in tax, we're always trying to minimize taxable income. So we want to defer the revenue if we can, and we want to maximize the expense. I'm sorry, in tax, maximize the expense. Accounting, we want to show a really good year, so we want to accelerate the revenue typically, or the incentive is to accelerate the revenue and minimize the expense and maximize our net income. So two completely different objectives there. So you'll see that when it comes to things like software, the company has an incentive. They want to capitalize it so they don't have the big expense, so they can show more net income. And the rules, will tell you when those costs can be capitalized and not deducted, but just amortized over time, or when they have to be expensed immediately as they're incurred. So, I'll let you review those at your own leisure. But just keep in mind, there are specific rules on software. Okay, let's kind of dig into why this is important. So first, I want to talk about financial reporting. This is kind of the number one thing. You're keeping all these records so you can show your investor or your buyer or your banker how the company is doing, its performance, its position, and how it's changing over a period of time, and management for that matter. So again, this might be very basic, but I want to level set for the next few slides. So the first statement that everyone's going to want to see, is your income statement or profit and loss statement. And as its title indicates, it measures profitability. And it's basically revenue, that's your inflows from operations that are earned. Remember, we're doing GAAP typically, less your expenses. And when we say expense, it's not necessarily the cash expenditure, it's the cost of recognizing that revenue. And this is kind of one of the very fundamental things about accounting to keep in mind, is that it is very concerned with matching cost and revenue with the appropriate time period and matching that cost to the revenue. And so think about the matching concept, in the back of your mind. And that's why we have all these complicated rules. So that's revenue from operations, expenses from operations. And then on your income statement, you'll also see other non-operating gains and losses, interest expense, interest income, tax expense, things like that. Here's a sample income statement. I was going to put numbers up here, but I don't think I need to. You get the idea. Revenue minus your cost of sales, that gets you to your gross profit or gross margin, less your operating expenses. That gets you to your net income. You add your other income, you subtract your other expenses, and you get net income before tax. Then income tax expense, that gets you down to net income for financial accounting purposes. The second important statement that investors, bankers, acquirers, and sometimes management will ask for is a balance sheet. And by the way, I just got off a board call before this where we spent quite a bit of time going through all of these, and you're never going to see them just one period. It's always comparatively. It's always going to be like, the past 3 years and then the next 3 of what they expect to happen. But here's the typical balance sheet. Assets, current assets, which is an asset that the way I think about it is going to be used up in a short period of time, like in a year. Cash, receivables, inventory, and then fixed assets, which is not going to go away anytime soon. Equipment, right? Plant, property, and equipment come to mind. Liabilities, again, current liabilities, they're due in the short term. Long-term liabilities, like accounts payable, vendor payable, salary payable, things like that. Long-term liabilities, maybe notes to the bank, notes to other parties. And then equity. So let's pause on this for a second. Paid in capital, that is what people have paid the company. Let's assume this is a corporation, have paid the company for its stock. And then there's a concept of retained earnings. in financial accounting, which is exactly what it sounds like. It's the earnings, the income of the company that has not been distributed or otherwise recapitalized, because sometimes you have to do that. And then there's within paid-in capital, there's paid-in capital for the stock, and then sometimes you see that separated into additional paid-in capital. But for our purposes, we'll say paid-in capital. The tax concept, by the way, rather than retained earnings, is called accumulated earnings and profits, which will usually differ from retained earnings because of these tax differences, and that actually has to be disclosed on tax returns. The third important statement that your investors are going to ask for, or buyers or lenders, will be a statement of changes in cash flow, because companies tend to live or die based on cash flow. I mean, you can be super profitable but not have cash to pay bills, and the graveyard is littered with the bodies of companies that had net income but no cash flow, and I've known some of them. So it's something that people need to keep an eye on, and it's exactly what it sounds like. What are the cash inflows? What are the cash outflows, right? Inflows from sales, outflows or proceeds, of financings or debt, outflows from expenses or purchases, even big expenditures, even equipment. So where, did cash increase, did cash decrease, and what's the trend? Okay. So let's move on. I want to go through the different reasons why this stuff is important. One is for the financial reporting, so you can tell people how you're doing. And again, comparatively, how you're doing year over year or period over period, assuming you're on a different sort of fiscal year. The second aspect of accounting that I want to talk about is what they call the assurance and attest side, or sometimes maybe the audit function. And this is where the first place you're going to run into accounting issues is just in the preparation of financial statements. The second place you're going to run into it is when those financial statements are attested by an accountant, by an auditor, in fact. And there's three levels here I'd like to mention: audit and review. Those are attest functions, compilations, and non-attest. In other words, the auditor is not saying in a compilation that he's not attesting to them. He's not saying anything that they're true and correct. He's just taking your numbers and put them together in a way that can make a statement. An audit, on the other hand, offers the highest assurance. And an audit is where the auditor is providing their opinion that the financial statements present fairly the results of the operations of the business. So it's a reasonable assurance from your auditor. And audits involve detailed testing, examination of source documents, third-party confirmations, sometimes inspections, etc. And then the auditor will issue an opinion. And that opinion is either unqualified, meaning that the financials present this is more my language, a true and fair view. I think auditors would freak out if they heard me say that they were attesting that something's true. Let's say they fairly present the results of the business with no material misstatements. But sometimes you see a qualified opinion, which means the auditors believe the financial statements are generally reliable, but there's some areas of concern. Sometimes, this is bad. You see an adverse opinion. They say, no, look, we can't give you a clean opinion on this. The statements are materially misstated or misleading. And similar disclaimed, meaning that they just can't express an opinion because the company is too much of a mess. So you don't want those last two, right? You want the first one, a clean opinion. But this is startup law, so I will tell you that in startup land, it's a lot harder to get that clean opinion than you might think, because you're going to see qualifications in startups fairly frequently. And oddly enough, and by the way, why are we doing this? Because your investor asked for audited statements. That's why. So they took your statements, they audited them, they got their opinion. That's usually why it happens. But oftentimes, you'll see these qualifications in startups. And if we had these sorts of qualifications in a public company context, I think there would be quite a lot of concern. I generally see these in startups and nobody loses their mind over it. So, because it's just the nature of startups. I'm not saying it's good. I'm saying that you kind of expect to see sometimes these qualifications pop up. There's some missing or incomplete documentation, weak internal controls, right? And that is very common. There might have been some error in the data. There might be some non-compliance with laws. I've seen qualifications that, look, we can't figure out the cap table. There might be some gaps even in monitoring practices. The one that I want to pause on that I see a lot is a going concern disclosure. And that's where the auditor actually expresses in the opinion doubt about the company's ability to continue operating. I mean, think how serious that is. Like the auditor saying, based on these operations, we don't think this company can continue to operate. We have substantial doubt about this company's ability to continue operating. They've got operating losses year after year, negative cash flows. They're not able to refinance debt or even get debt. Maybe they lost a customer. Maybe they've been sued by someone like me, or maybe it's just, the market has changed, right? And, maybe you're selling, VHS and now the market has gone to streaming or whatever. So we see this pop up in startups because what I've just described, that pretty much describes a lot of startup companies, right? They have losses year after year after year and negative cash flows and plan on having losses for the foreseeable future. So the going concern disclosures, it can be explained. It can be explained away. And given who the audience is, they understand that that is an issue. That's the risk. That's the risk they have to take in order to, get that 100x return when things do turn around. A review report is very limited assurance. It's not an audit, but the auditor does perform some procedures. They do some questionnaires of management. They'll state they're not aware of any material misstatements. Private companies will sometimes do that. They don't want to spend the money it takes to get a full audit. And a compilation is no assurance. It's just, we just prepared the financials. We're not verifying the accuracy or completeness. That's usually an internal use matter. You want to be careful providing those to outside parties. I want to mention a little bit again, the law of accounting, licensure. The certified public accountant is a designation you've probably heard of most, CPA. It's a state level licensing process. That's why I had to go through 2 different states. And that's a CPA can provide auditing, tax, financial reporting, and assurance services. There is a uniform exam. In many states have a work experience, but that is changing or flexible in a lot of places. And it's usually required for audit services. There is such a thing as a certified management accountant, which does what we're going to talk about in a minute, management accounting, and a certified internal auditor through the Global Institute of Internal Auditors that does internal auditing. We'll talk a little bit about that in a minute as well. So just want to let you know what the designations are. And then finally, an enrolled agent, which is a term I hear people use kind of colloquially for pretty much everybody else. But I mean, technically, I think of it as somebody who's authorized to practice before the Internal Revenue Service or represent taxpayers. Okay, so managerial or cost accounting or management accounting. So I've told you what financial accounting is. The idea that we're presenting this financial information for your lenders, investors, buyers. But there's another type of accounting, and that's where we want to use financial information to make management decisions or make business decisions. So rather than external reporting, this is just really focused on our control and our strategy decisions. For example, we might want to know if costs are getting out of control and where the costs are, or if the costs in this particular, like, are my marketing costs more or less than last year? Did I spend more in advertising or last year? Where do I see places where I can cut costs, or where do I see where revenues are doing well, not doing well? So it helps managers, do forecasts, allocate their resources, set budgets, monitor their operations. So this is different than financial accounting because it really gets, well, let me give you examples. It really gets into more just using this for purposes of making decisions going forward as to how you're going to change the way you do business. Annual budgets, for example, cost analysis. What is the cost per unit of production? This is where it comes up very often. And we do whole classes on cost accounting. How do you allocate cost to a product? So you know how much you have to price that product at, for example. Variances. So we'll compare actual results to budgets to see where we're being inefficient. Forecasting, and then break-even analysis, which is something that I guess it doesn't matter much in startups, but when I first started doing this, everybody was very concerned about where break-even was, and what sort of profit they had to have and how much you had to price the product at, etc. Cost accounting tracks, records, and analyzes the cost associated with producing goods or services. We talked about that. Some different cost accounting methodologies, standard cost, process costing. I don't want to get too deep into that. That's going a little deep in the weeds. Okay, the next thing, financial ratios. This is the other place where accounting, again, this is not financial reporting for people just to see how you're doing year over year. This is not so much giving management information to make managerial decisions. This is really interpreting the financial data to understand profitability, liquidity, solvency, efficiency. In fact, I'd say it's borderline microeconomics because we're analyzing that financial data to find trends and to see how the company's doing year over year. So we've got ratios. So let's talk about a couple of them so you get an idea what I mean. So we'll see oftentimes current ratio. What's your current assets to current liabilities? And in my world, where I've seen this applied, well, first of all, just because people want to know how you're stacking up against everybody else, but also it's a good way to spot inefficiencies. And also in tax, we will go back to the financial account, these financial ratios sometimes just to determine, this goes way beyond what we're talking about, but it's useful in transfer pricing analysis, right? If we're going to do transfer pricing, we're comparing comparable companies to each other, and this will tell you how comparable they are. So current ratio, current assets divided by current liabilities, quick ratio, current assets, less inventory divided by current liabilities, working capital. This is a big one, working capital. This is going to come up again and again. People really want to know this one, and I'll talk about this more in the M&A section. But that's current assets less current liabilities. Remember, current assets, we're going to use them up in a short time. Current liabilities, they're payable within a short time. Accounts receivable turnover. How often are we turning over our receivables? That's net sales divided by receivables. Same, inventory turnover. How often is that inventory being turned over? That's the cost of sales over inventory. And then debt to assets is one you probably hear about, and then debt to equity. And these become super significant a lot of times in tax because it's a good way to root out if somebody is doing something tax-wise that doesn't make a lot of economic sense just in order to get a tax advantage. Then there are profitability ratios that you probably have heard about: gross profit margin, profit over sales, operating profit margin, operating profit over sales, net profit margin, return on assets is a big one, net income over total assets. And this is less, I never hear about this in startups, earnings per share, because usually we don't have any earnings. We're just, we're focused on building a business, not focused on earnings, net income. But in public companies, it's a very important metric. Price earnings ratio, same thing. Dividend yield, we don't pay dividends in startups. So these are profitability ratios or something like it, that some of which we see. Now, it's taken me 38 minutes to get into some startup legal issues. now that we have kind of gotten an idea of, the basics. So number one, no, we'll say, where accounting can get you in trouble or not, is in option backdating. And so keep in mind what I said earlier. You're trying to present as good a picture usually as you can of the company. That means the highest net income, right? So you tend to not only maybe want to overstate revenues, but understate your expenses so your income's high. And accounting is always about thinking about how these things kind of play out at the end. Well, so suppose you grant options to somebody. Well, that option grant is an expense to the company. I'm not going to get into how that expense is measured. Let's just say that it is an expense. And it's the more the option is worth, the greater the expense to the company. So 20 or 30 years ago, what companies would do is they would say, well, on the flip side of this, if I grant the option when the value is really high, the strike price has to be high, and that means the employee has to pay a lot more. But if I grant the option when, at a different date, when the value is low, the strike price is low, and the employee pays less. So that really favors the employee, and it helps us, the company. So we're going to backdate these options, and we're going to grant it at a time. Today is December 17th. So we're going to say, look, a year ago, our stock was worth, 10 cents, and today it's worth 20 cents. How about we just put on the option that we granted this a year ago? We'll backdate it. And that way we'll price it at 10 cents instead of 20 cents. So what that does is that it messes up the financials. And it also, the option is not granted until the board approves it, typically, or the compensation committee. So it also misstates the financial records. But the biggest thing is we've understated our compensation expense when we do that. And oops, did I miss a slide? Yes, I did. So here it is. Yeah, this is the one. And there was a time in this valley when everybody was doing that. And eventually the SEC caught up with it, and it was just a wave of litigation and charges and scandals, the option backdating scandals. And hundreds, is way more than 100 companies were investigated. And notice it's SEC, which will impose civil penalties, but the Department of Justice, which enforces criminal laws. So there are people who went to jail for doing this. There are a lot more people who ended up paying big fines, and there are a lot more people whose careers were pretty much ended because of option backdating. And it's two things. It's number one, first of all, you're cheating the IRS because you're not pricing it right. You're not picking up the compensation and income. But secondly, you're also misstating your financials when you do that. So the second thing I want to talk about is contingent liabilities. And so this is let me make sure I got my slides a little out of order, but that's okay. So contingent liabilities. So remember what I said, we got to pick up our expense, and we also have to show the liabilities. And when do you do that? What if that liability is like really remote, right? What if it's like a warranty claim that you don't know if it's going to be made or not? So there are rules. And if the loss is probable and the amount can be estimated, then we have to record that liability in the financials. Okay. If it's reasonably possible, so it's not remote, but less than probable, it doesn't have to be recorded, but it has to be disclosed. So, and if it's remote, then it doesn't have to be recognized or disclosed. This comes up in litigation. This comes up in product warranties and loan guarantees, environmental obligations. Now, this is a seminar on law, so you probably know what I'm thinking as a lawyer when I see this. We have to disclose to the world these contingent liabilities. Well, do we really want our financial statements to say, gee, we think we've got some probable liability for this litigation to this potential plaintiff? right? And that's where there's a lot of tension in this space. Or gee, we think we might have to, incur some cleanup costs. Do we really want to tell that to the world and put that out there? And we do see some tension between this issue of contingent liabilities. That's one reason. The other reason is the company would generally always like to take the position that these things are remote and not have them show up on their books. So this is a place where oftentimes you'll see companies at odds with their accountants, which is not a place where you want to be. By the way, it's a big deal, if an accountant has to fire a company. Okay, this was the option backdating. Okay, the third one I want to mention, I talked about the liabilities, I talked about option backdating. The third place where I see this play out is in revenue recognition, and this is big. And we talked a little bit about this, I think, in an earlier podcast where we have the scenario where the startup's going out to its investors and they say, "Gee, do you have revenue?" And it's like, "Oh, yeah, we got revenue. We got purchase orders, from all the big companies in Silicon Valley." Well, they don't have purchase orders. What they've got is like a conversation. And people make that mistake regularly, where if without good advice, they'll record something as revenue when it's not really allowed to be recorded as revenue. Well, keep in mind what you've done is you've violated an accounting principle. And there is a framework that says when you're allowed to recognize the revenue. And this really comes up in software. But the bigger place, if you're not in software, the typical scenario, and I've seen this over and over and over, is the sales guy goes out and they enter into these non-binding agreements or a non-binding purchase order. And they come back and they say, "Yeah, we got this purchase order." And then that means under accrual concepts, the revenue from the sale gets picked up on the books. Well, if the order is non-binding, should it be on the books? And sometimes the answer is no, it should not be. You haven't met these conditions that allow for revenue recognition. And that happens a lot. And that's when companies get in trouble. They might have to restate, but their financials are not going to be quite right. So, and I'm assuming that's the innocent case. There's also the not so innocent case when companies will just inflate their performance, that recording sales too early when they know it should be. But usually good accountants will be looking at those sales contracts and find out, what's binding, what's not, so they don't mess up on revenue rec. Several cases on this. This comes up a lot. And I hate mentioning companies, but these are such big companies and everyone knows. So, I'll just say this is what has been in the press, charges against several companies about accelerating recognition, and it's all through improper accounting. And usually it's the SEC that concerns the most, but look at that last one. Fraud charge by the Department of Justice for fabricating documents in order to recognize fraudulent revenue. And I do know personally of lots of executives that have gotten into trouble on this as a criminal matter. It's easy to do, and that's the problem. A couple other accounting scandals that we can't do something on legal aspects of finance and accounting without talking about this stuff. Of course, Enron was the granddaddy of them all. You might remember Enron. And in fact, I had my own personal experience with them right before this happened, because I had a client that one day showed up with, they couldn't get financing anywhere. And they showed up with this complex proposal from Enron. Fortunately, we did not do it, and I didn't hear anything more about it. It was the first time I heard about them, and then a year later, they're all over the paper. Anyway, they use mark-to-market accounting and special. I'm going to talk more about that in a minute. WorldCom was the other really big one that happened about the same time, about 25 years ago. They were accused of fraudulently capitalizing operating expenses and overstating their assets. Look at that, 25 years in prison for an accounting mistake. Lehman Brothers, again, an accounting issue. It led to bankruptcy lawsuits against the executives personally. So it personally wiped out people individually. Not criminal convictions, but pretty massive civil cases. Now, Enron. So I do want to pause on this one because it's worth noting that we're talking about it even today. We're talking about the Enron case because it really fundamentally changed so many things in the space. It's probably because of Enron and WorldCom that we have what we call Sarbanes-Oxley. In other words, we have a body of law forcing companies to put a set of internal controls in place. It's probably because of that, I don't know, but cases after that that led to Dodd-Frank, which is an additional set of financial controls. It's probably because of Enron that it's so hard to go public anymore. And it's so risky for anybody to want to be a director because this started an era of increasing financial regulation. And Enron did really a couple of things. Number one is what they called mark-to-market accounting. They booked the present value of their profits from long-term contracts immediately on signing the contract. That inflated revenues and earnings that they were never going to get. Secondly, and probably the really more the guts of Enron, when I think Enron, this is what I think, is they had created off-balance sheet partnerships. In other words, they created these single-member LLCs and or something like that, and then just pushed debt and losses into those LLCs and did pick it up on their own returns. And generally, the structure was complex. It was opaque. Outsiders really could not figure out what their true financial condition was. So this is a case where they got in trouble over accounting problems. Now, I've had my own clients who you won't read about in the papers who've gotten in trouble over accounting problems. And they will tell you that it is not nearly as cut and dried as it seems. They will tell you that they went to jail for a mistake. This was an accounting mistake. I'm not a CPA. I didn't know. But the SEC or the Department of Justice or whoever saw it differently and said, well, you know what, you should have known. So you got to be really careful with this stuff. A couple of other places where startups get in trouble on this. We talked about it, booking income that's not recognized. That's kind of a subset of revenue recognition. Understating expenses, because they paid for it out of their own pocket, so it doesn't go on or whatever. Well, that's the personal expenses. It's the flip side of that, where the company itself is booking their personal expenses. Payroll taxes is a huge one. We're going to talk about that a lot in 2 weeks because when I talk about troubled and distressed companies. Related party, conflicted transactions, and then just outright fraud. Now, I want to say, oh boy, I might even get through my slides. I want to pause on partnership for a minute because I know some startups form as LLCs, taxed as partnerships. This is a whole different world, right? I told you about tax accounting. I told you about financial accounting. There's also a third set of books that you oftentimes have to keep when you do partnership, just for partnership accounting. And just keep in mind really 3 things. Number one, distributions and income allocations are not the same thing, right? People interchange those terms and they get confused and messed up in a partnership agreement. Profit and cash are not the same thing. It doesn't even make sense. Profit is a concept, is a financial concept. Cash, we know what cash is, right? Capital account is not the same as tax basis, and tax is not equal to book. And I have some slides here that illustrate that. But given the time here and the fact that you'll all fall asleep, I don't want to spend too much time on it. But this is the kind of stuff, these are what they call T accounts. And this is the kind of stuff we always do, or I always do, whenever I set up an LLC or work with an LLC. We figure out what the book capital account is. And capital account is increased by income and contributions, decreased by losses and distributions. And it has significance in tax. So we got to keep track of it. And then we keep track of what the tax basis is, which also has significance only in tax, but we have to keep track of that too. And they get out of whack. So we got a typical startup right, that has raised no money, we'll say, and it goes out to the investor and says, look, we'll give you 10% for $100. Okay, well, that means the founder's interest is worth 90%. Now, if we do what I call a book up, so all the numbers are in sync when we liquidate, then we'll book up the founder so that he has a $900 book capital account, but still it's zero. He doesn't change his tax account, his tax basis at all. Any investor is book tax one. I guess I am going to go through it. Let's say the next year we go out and borrow $1,000. Well, the rules generally would require you to allocate that based on other allocations of profit and loss for purposes of figuring out your tax basis, because you get increased tax basis for debt, but you don't for capital. So now we got to make a debt adjustment. So you can see how complicated this can get in a hurry. And this is one of the reasons, this is not trivial. It's one of the reasons startups don't do things as LLCs or partnerships. You drive your accountants crazy with all this stuff if they're actually doing this. Merger and acquisition, I just want to mention a couple of things. Why is this important? We're doing a whole hour next month on M&A, so I'm going to save a lot of this for then. But just keep in mind that purchase price is oftentimes based on a multiple of EBITDA, earnings before interest, taxes, depreciation, amortization. So we have to, sometimes, okay, that's purchase price is based on EBITDA, so that number's got to be right. All right. Otherwise, and I've had it happen in my practice where we said, look, we're going to pay you X times EBITDA, and we close the deal, and the buyer comes back and says, you know what? Your EBITDA is wrong. You overstated it. And also, therefore, our price is millions of dollars less. So we want to get that right. Earnouts, which is contingent consideration, is often based on revenues, net income, or something else like that. So what is revenue? What is net income? And then finally, there's working capital adjustments, meaning that after we close, and again, we're going to talk way more about this next week, but the buyer is going to increase or decrease the purchase price based on how far you are away from a target working capital number. So again, we got to figure out, what working capital is. And the one big mistake people make on this, who don't really think through the accounting stuff, is they just say, you know what? All these numbers, that's fine. It's all based on GAAP. And that's the wrong way to do it, because we can argue about whose GAAP we're going to use and what GAAP means. And plus, I'm not sure I know what it means for every company, so I would rather just specify, what the accounting conventions are when we do this, but that's next month. One thing I do want to mention, because this drives lawyers crazy too, is goodwill. So there's a tax concept of goodwill where you amortize it over time. That's how you figure out if you purchase goodwill and are allowed to deduct it. The accounting concept is much different. It's not an amortization over time. Oftentimes, it's just what they call impairment. And I've heard it said that goodwill gets impaired immediately upon close. So you have a big expense immediately upon close. That might be a little arcane. I'll just say that if you're trying to make your debits equal your credits and your tax numbers to match your financial numbers, goodwill is one you'll spend quite a bit of time agonizing over. Where does accounting come up in legal actions? Sometimes in estate and gift. Usually where I see it is if we have disclosures of business actions, if we're in court on an embezzlement or fraud case, if we're trying to calculate economic damages, or if you're an expert witness trying to present financial evidence. And I want to close with a handful of recent cases. I took the names out. I just don't like to call people out, but I did tell you what these companies did. So a fashion tech startup forged financial documents, falsified financials, defrauded investors. That did not end well for anybody. Fintech founder was arrested. Again, falsified documents to mislead investors. Here's a digital pharmacy startup. These are the individuals, keep in mind, not just a company. It's not like, oh, well, company failed, they'll go start another one. They went after the individuals in these cases, all of these cases that are listed here. And this is, just a drop in the bucket of what's out there that I probably could talk about. So I'm just closing to say that this stuff is important. We have to pay attention to it, and we have to get it right. With that, you know what? I'm going to drop this information right here into the chat. My contact information, my LinkedIn, my newsletter, my podcast, a couple of websites I like. That's me. That's my 2012 book. That is my 2020 something book, 2023, I think, 2024, 2022. Anyway, I'm Roger Royce, and this has been Finance and Accounting for Lawyers. So thanks for joining.
Thank you, Roger.
Okay, hold on here. I said I would drop this in the chat. I don't know how I forgot to do that.
Who could ever go without having an accountant in their company? My goodness.
Yeah. Okay, everyone. Let me close the recording.